In this video, I'll walk you through how to correctly account for compensated absences given the information that's presented in this problem. And so you've gone through and read all of this, and what we always need to keep in mind when we're looking at a company's policy as it relates to compensated absences, and that is paid time off, like sick time payable and paid vacation and holiday pay and that sort of thing, is that the FASB has set forth some very specific criteria in determining whether we do actually expense the associated benefits or not. So before we walk through how to calculate this, I want to just show you what the codification has to say about compensated absences, and this matches exactly what the book has to say. I know it's not all on the screen here, but I'll scroll over shortly. But it says that we should accrue for a liability for their compensation if all of the following criteria are met. So we have to meet all four of these criteria, A, B, C, and D. And the first one says, look, has the employer's obligation, has the service already been performed? Okay, so we would look at this example and we'd say, yes, it's the end of the first quarter for this company. The employees have already performed the service and they've accrued some sick time and some vacation time. So we've answered yes to that first one. Again, this is to figure out whether we should record a liability and any corresponding expense. The other thing is to determine whether the compensated absences vest or accumulate. That's what the wording says here. So that just means even if they quit or are fired, they'll still receive this paid time off. And if you read through our problem, the answer is yes, it accumulates. And then C, payment of the compensation is probable, and that's, we're going to say it is probable. The company is a going concern, and they want to exist for a while, and they'll have to pay these out legally. And then finally, can it be reasonably estimated? And we answer yes to all of those. So what I've done here is I've summarized, I've created this little table, I guess, based on the information presented in the problem here. Kind of a lot to swallow just looking at one big paragraph. But what we're told is that the employees, there are 5 employees, each one earns or is allowed to use up to 8 days of paid sick time every year, and they earn a day of paid vacation as well for each month worked. And so we're looking at the end of the first quarter, which is 3 months, and I've developed 2 columns here, one for sick time and one for vacation, and then a total. And so the vacation, they tell us that they earn 1 day per month, so 3 months have passed, they've earned 3 days. The 8 days, that's for a full year, which would be 12 months. There are 4 quarters in a year. I'll take that 8 and divide it by 4 because we're only looking at 1 quarter. So that means that each employee has a right to 5 days total paid time off, 2 being sick, 3 being vacation. And we're told at the end of the problem the growth. So we've calculated how many days, but we need to get a dollar amount. That's the reasonably estimated portion that the FASB has asked us to determine whether that's true or not. So we're told here the daily gross wages for each employee is approximately $160. So per day, I'll put this in here, they're going to earn $160. That means when they take the time off, that will pay them $160 per day, per employee. So the total cost per employee for the sick pay is the number of days times the wage per day, $320 for the sick, $480 for the vacation. You add those two together, that's my total compensated absence liability for each employee. Now there are 5 employees, and each employee will get the same amount. So the total cost, this extended amount here, is the total cost per employee times the number of employees. So for all the employees, we have $4,000 of compensated absences that we've guaranteed or promised to our employees. So I need to account for that, and you can see it's already populated my journal entry. And the idea here follows the matching principle, and that is that the cost of the compensation is expensed in the year that they earn it. So in the quarter they earned it, we're going to expense that as wages, the $4,000, which came from up here. And since we didn't pay it out in cash yet, it sits under our liability section of our balance sheet as a future obligation of $4,000. So it's that simple. And the second part of the problem says, okay, well, tell me what the balance sheet would look like relative to that liability at the end of the quarter. So we'd show up in our current liabilities. We would list all the current liabilities like accounts payable, salaries payable, and here you can see compensated absences. So it becomes one simple component of the current liabilities. Now I'm going to show you something that the problem didn't ask you to show, and that is that currently in the balance of this account we have $4,000 that was accrued for in the first quarter through this journal entry right here. Now subsequently, if those employees take paid time off in a future quarter, what's going to happen is we're not going to expense that wage, that cost again. In other words, this has already gone through the income statement. It won't happen again. If let's say that the employees took all of those paid days off in the next quarter. So we would simply take and we would debit liabilities for compensated absences in the amount of 4,000, and we would credit cash for 4,000. So what happens, instead of hitting the expense account, which would have happened when we accrued it, we exhaust that liability. It works its way out to zero, and we don't hit the income statement. Instead, the balance sheet is adjusted to correctly reflect the amount that exists in the compensated absence account. So that's the end of the problem. I hope that this was helpful for you.